Recorded in action. Good morning, guys. How are you today?
Good, thank you. And you?
Thank you. Thank you for being here. So, this presentation today is a special program that we have. It's called Smart Start. We utilize an IUL to build wealth for children. And the idea is to help you fund how to figure out how to fund your kids' life from preschool to college and beyond. So right now, the theme of our presentation is that life happens, expect the unexpected. So if you have a child, you're gonna have all kind of expenses that are unexpected, and the best way to be ready for it is to prepare for it. So hang on here. Sorry, I apologize that that slide's a little small. I'll work on that for the next time. So a quick little summary on who we are. We are a team of dedicated uh, individuals, educating families, employers, and entrepreneurs on the benefits of advanced markets to facilitate tax-free wealth while protecting what matters most, which is your children. A little bit about me. I'm an entrepreneur since birth, been in the field of education for about 20 years, then got into real estate. And during COVID, I wound up transitioning and got my insurance license. And since then, I've been on a mission to protect, where I wasn't always so keen about it. But after COVID era, I really believe everybody, no one should be caught with their pants down, and everybody should have insurance. Give me 1 second. Okay, so I got remove that. Just a little bit about us on the bottom. If you see there, we have we represent the top A-rated companies. You might recognize some of the companies that are on the bottom of this screen. Okay, so hang on, bear with me. So what do we do? Basically, we protect life's journey. We protect people in several different areas, from life, which includes accidental, mortgage, term and whole life, final expense. We cover health, also. But today we're on the third column, which we're doing asset management and wealth strategy, specifically the Smart UL. So today is a workshop specifically for parents. Okay, so our license allows us to help people in 5 different ways. One is utilizing the Index Universal Life, which would allow you to protect your house, your family, and your income. Uh, the other bullets there are mortgage payment protection. For more information on that, you can go to our website. We have final expense, we have debt free life, and today we are doing number 5. Okay, so how can an IUL be utilized? An Index Universal Life can be utilized for college savings, tax free savings and retirement, and income for life's journey, and most importantly, rainy day money. Okay, key benefits. The key benefits are protection and accumulation. So while you're protecting your child, your house, your everything, or you when you're putting money into this account, you have what's called cash accumulation. And basically, this provides lifetime coverage. You're building savings with compounding interest. It has living benefits. You have access to your money tax free, and you don't pay capital gain on that growth. And most important, you have a lot of flexibility. Okay, so some of you might have never heard of an Index Universal Life, but it is not something that's new. A lot of people that are wealthy have already been utilizing this concept for a long time. Originally, it goes back, you can date it back to like 1997. It was Transamerica that first offered it. And since then to now, 24 years later, there's over 52 companies offering the Index Universal Life. just a little evolution of life insurance. Originally, when people thought about life insurance, it was just about, protection, and then the next thing, it was like focused on the death benefit. But with time and life, things are always getting better, better, and better. So back, I'm just giving you the transition. It went from term to whole life to universal life to variable universal life, but a lot of people did lose money in there. And then in 1997, with this product, it's a fixed index product, so you'll guarantee never lose money, and I'll show you why and how. Okay, so what does an index universal life do? So it number one, increases in value during your lifetime through a cash value component that grows tax-free and can be accessed tax-free. The cash value portion of your policy earns interest based on the performance of an underlying market index. Even if this index goes down, your credited interest rate is never than 0% guaranteed. So how does it work? So the index universal life is designed to increase in value during your lifetime through a cash value component that grows tax. I read that already? Yes? No, yeah. Sorry, guys. Screen. Okay, how the IUL works. Sorry about that. Oh, and why it works. Okay, so here it goes. Number one, you're making your premium payments. Number two, it's an accumulated policy value into a fixed account. You could make withdrawals, and it has a policy death benefit. Okay, why it works? Okay, some of you might have heard of the 7702 IRS code rule. Some of you may have never heard it. So why it works? Think of it as a Roth IRA married to a life insurance policy, because we are taking advantage of Section 7702 of the IRS Code to, number one, overfund a life insurance contract with the ability to withdraw tax-free wealth. It's a life insurance policy loan. A life insurance policy loan isn't taxable. All the while, the principal amount earns interest, which equals leverage. Enjoy the best of both worlds while providing a death benefit and provide tax-free savings and retirement. This is a more detailed explanation of the 7702 and why it works. So the main thing is it differentiates the tax code. Certain types of permanent life insurance differentiates between income from a genuine insurance product and income from an investment vehicle. The proceeds of a true life insurance contract receive favorable tax treatment. In addition to the death benefit, that typically passes tax-free through the cash value of permanent life insurance, grows tax-deferred, and will never be taxed, so as long as it stays in the policy. The key advantages here is that you can borrow against the cash value tax-free, and the funds can be used for any purpose and paid back whenever you decide. Plus, a life insurance policy loan has relatively low interest rates. Anything you do not repay is simply subtracted from the death benefit upon the insured's passing. Okay, so a lot of people that are parents are savvy, and some parents already have something in place. There's a policy out there called the 529. And I just want to bring the awareness that the 529 has certain limitations. And is it possible that your kid doesn't want to go to college? And what happens if you save their whole life and then they don't go to college? And in the 529 plan, it has penalties when you don't use it for the purpose of education. So can you imagine that you saved all your life for your kids to go to college? They don't want to go to college. Are you going to force them to go to college? Or, you're going to lose some money. So that's why one of the reasons why the IUL outperforms this 529. Another thing, I'm going to give you the pros and cons here. So IUL is on the left. So you have tax deferred growth on both. Dispersed distributions, non-taxable, that's on both, can be used to or transferred to benefit multiple children. You can do that with both. But here's all the differences right now. The restrictions is the 529 is not protected from market downturns or loss. The 529, you cannot access the funds due to chronic or critical illness. And the 529 is not counted as an asset when applying for federal financial aid. I'm saying, sorry, IUL does, 529 does not. So in summary, it's flexible, it's tax-free, could be used for education. They could use it for the down payment of their first home. You could use it to fund their preschool, their braces. It depends on what you want as a parent and what your goals are. The overall utility of the IULs are extremely versatile when it comes to a child's financial future. Many parents wish to give their kids a head start whenever they can. So today we're going to look at using an IUL for college savings as an example. Okay, so just imagine at this moment, I would ask the parents how much they're saving now, but just in general, this is just a glance at college. The average cost of college in the United States of America right now is $35,331 per student per year, including books, supplies, and daily living expenses. That's a lot of money. Are you prepared for this? Did you start saving already? The average in-state student attending a public four-year institution spends about $25,487 for one academic year. So these numbers are like really staggering. You can read them for yourself, but the most important thing is just preparing. If you don't prepare, it just doesn't happen. The kid is going to get to 18 years old. There's not going to be money for school. There's not going to be money for anything. And I firmly believe that it's a parent's responsibility to start their kids right. Because if they don't do it, who's going to do it? A kid at 2 years old doesn't know anything about anything. Okay, some terms to understand when you're talking index universal life is, number one, when you hear the term accumulation, that means growth. When you hear distribution, it means income. And when we talk about legacy, we're talking about lifetime protection and wealth combined together in one policy. Okay, so I'm sure your parents told you should always save for rainy day money. I'm not sure where you've been saving, but this is an illustration of you saving $250 a month in a 40-year period. So some people do not trust banks and they prefer their handy mattress and putting the money under the mattress. If you go on that avenue, you'll have 0% return. Some people, most people, will put their money in a savings account. But the problem with that is that in America, in a savings account, the interest rate is generally less than 1%. And to get a higher interest rate, you have to put a large amount of money in. So that's why a lot of people turn to CDs, 401ks, IRAs, as opposed to a regular savings account. Some people consider their house as that investment that they're doing, that their life investment. I'm going to get a house. It's going to double in price. It's going to increase in value. In this example, we show it to have average rate of return of 3.7%. And that's $274,000 in the 40-year period. And now if you look at the last one, if you put your money in an index universal life product and let's just say the interest rate is an average of 10.7%, in the 40-year period, you would have over $1.6 million in there. And this is just an illustration of how the IUL can be used as a vehicle to accumulate wealth. Now I'll get a little more deeper into it on the next slide. How does this happen? Hang on. Okay, so exactly, it happens because the money is put in the S&P 500 and an index called the Barclays Trailblazer, and basically, the S&P is the single best benchmark in the United States of America. It includes the 500 large cap common stock actively traded in the United States. The Barclays aims to track a diversified portfolio of assets with the highest return potential for a given level of risk. You have the ability to change its portfolio and as often daily to adapt to shifting market conditions. The cash value in the Index Universal Life policy earns money based on the performance of a selected stock, but with a built-in floor. Again, protecting you from downturns. This chart, I love it because it shows how the market did from 2000 all the way to 2019. The blue line represents the fixed index, and the red represents a variable. And when you look at this, you could see that in the last 20 years, you would never have lost money at all whatsoever. And you would have seen gains as high as 12%. And in the reverse, you would see that you actually lost money several times. And when you lose the money, if we look at 2002, what happens here is that if you started with a certain amount and then it dropped, now you got to work yourself back to just being breaking even. So if you were in that thing in 2002, you see it took 5 years to just get back to where you started, which is very bad. I like the next slide because it gives a better example. So let's just pretend you had 100,000 in a regular stock account and it drops 15%. What does that mean? You would have $85,000. Now, if you had the same amount in the cash value of an IUL and the index dropped 15%, guess what? That you still have your 100,000. So that is the floor. But here's the best part in our example. Let's say that same index grows 15% the next year. Okay, in the stock account that dropped down to 85,000, now it would have 97,750,000. You still haven't even recouped your full money, and you're back to where you started. But with the index, if you look, now, if it went up 15%, you would have 115,000. So where would you prefer to be? The variable or the fixed? The fixed is the safest route that you can take because it prevents you from losing money and, more important, losing time trying to regain your losses whenever the market drops. So this is just a history of the stock market and how you could use the tax-free saving, the IUL for tax-free savings for today. So looking back to 1929, you see there was the Wall Street crash. 1987, we had the Black Monday. 99, the dot-com bubble. The 2008 was the subprime mortgage crisis. And then in 2020, we had the coronavirus. I'm flipping back to this chart again one more time. So all those phases of life that I just showed you, they're all here where you see these major downturns. And what do you see right now happening for the future? And when it comes to your own family, they say this: control what you can and ensure everything else, because we don't know what's happening right now. Some people believe we're going into a recession. Right now, it's a struggle for some families making ends meet. So what can you do is plan and prepare is what you can really do, because it's not if life is going to happen. Life is going to happen. Good, bad stuff is going to happen. So the only option that I could say is, if you start one of these, you could have some peace of mind that you will have funding for your kids' future from preschool and beyond. I'm going to end this now with did you know? Did you know the following entrepreneurs used an Index Universal Life kind of policy to fund their dreams? I'm going to start with Walt Disney. When Walt Disney wanted to do his theme park, and he told the banks that he was going to have roller coasters, they were going to go upside down, there was going to be people swinging from things and jumping from things. There was not a bank in America that would risk giving him a loan because of the liability. So what did he do? He liquidated his cash policy, and that is how Walt Disney was born. My second favorite example is Ray Kroc. Ray Kroc is the guy who kind of forced the McDonald brothers to force the McDonald's to him. Originally, he had a vision of McDonald's in every corner, but the McDonald brothers did not. Ray Kroc recommended to the McDonald brothers that they buy the land underneath the McDonald's instead of leasing. They thought he was crazy and they fired him. What did he do? He was a serial entrepreneur. There wasn't a bank in America that would give him a loan. He liquidated his cash policy, and the rest is history. So basically, I want to really stress here that when you do this IUL for your child, this is not a policy that you start and you quit it tomorrow. But as a parent, you have three choices. Number one, you could fund your child's life from whatever age they are now to 18 or 21, and then you stop. And then they can take over the plan, or it could just stay there and you never have to put another penny into it. I can give you some illustrations, your own personal illustration, but in order to do so, we always have to know what the parents' goals are at first. So one is you fund it from whatever age they are to age 18, or you can take and you could fund this policy till they're 65 years old, and you could do $50 a month. You could do $100 a month. You could do one-time dumpings once a year. The most important thing that I'm leaving with you is that this is not us telling you kind of what to do. This is you telling us what you want, what your dream is, what your financial goal is, what your plans are. And we help you put that plan in place as soon as possible. That is the end of this presentation. I hope you found it valuable. Right here on the bottom of the screen, I don't know if you can see it, because it's very small. But if you want to book up an appointment right now, you can go to my Calendly link by going to michellereyes.biz. And if you are a guest here invited by someone else, I'm going to recommend that you send them a text right now and say, I want the Smart IUL, and they will send you their calendar link, and we will help you get this in place as soon as possible. Thank you. Do you guys have any questions? Okay, well, I thank you guys for being here. Have a great day.